All right, so we are officially recording, which means class has started. It is week 4 of Principles of Business, so this will be our last live class before it ends. And don't forget that the class is officially over. The hard deadline is 11:59 p.m. on next Sunday. So all the grades look pretty good. I'm not really unhappy with them. So just keep it up for the rest of the week and we should be okay. Any questions? I said that already, but I just want to double check and make sure. All right. Well, I'm going to share my screen. And I know everybody's going to just love what we have next here. What does always change everything when I share my screen? All right. We are going to talk about accounting. Has anyone had a accounting yet?
No, and I'm not looking forward to it.
Oh, it's
I've
not
had
that
it.
bad.
I've had it.
We got it in stereo. So what did Mary and Deidre think of it?
It is not for me. Definitely. Not something I'm going to do professionally.
Well, accountants make big money.
Yeah, I don't want to be an accountant either, but I enjoyed the class.
We'll see. That wasn't so bad. All right, so let's talk about accounting. Now, I added a couple extra slides in here and a video. We'll talk about our learning outcomes. We want to define accounting, describe how accounting information is used by a variety of stakeholders. And remember what a stakeholder is, right? Somebody who has stake in a company, like someone who owns stock. Stockholder, stakeholder. Sometimes who did we lose? Oh, there she is. Owners, people like that. Identify the purposes and goals of generally accepted accounting principles, which is also called GAAP, GAAP. Describe the key elements to the major financial statements, which will be your income statement, your balance sheet, and your cash flows. Those are the 3 main ones that you can get a good picture of the financial health of a company. Describe several methods stakeholders can use to obtain useful insights from a company's financial statements. Explain how budget process can help managers plan, motivate, and evaluate the organization's performance. And explain the role of managerial accounting and describe the various cost concepts identified by managerial accountants. Okay, accounting. And I'm going to have another definition here in a minute. It's a system for recognizing, organizing, analyzing, and reporting information about the financial transactions that affect an organization. Now, what we have here is the tax code is super complicated. We'll talk about that in a minute. And it would be much easier if there weren't so many governmental regulations, the tax code, write-offs, things of that nature. Because one of the main reason for accounting is to let the government know how much they can charge you, and they give you all sorts of ways in and out, depreciation on buildings, on equipment, and things of that nature. Goal: to provide users with relevant, timely information that can help them make better economic decisions. Okay, here's the extra stuff I was talking about. Okay, anybody know who Warren Buffett is? I'm sure everybody does, but
He's very interesting.
yeah, he is super rich too. And he said accounting is a language of business, and he's right. That's absolutely the correct way to look at it. Okay, so part of it, what I put in here, accounting portrays a clear picture of the profitability and solvency of the business during a particular period of time. So what you're getting is you're getting a snapshot of the financial health of a company. You're just getting a snapshot at the period of time it's taken. Hence, accounting acts as a communication tool that provides pivotal pieces of information and guides the future courses of action of the business. So you just have to know, how much money you have, how much you've borrowed, and your assets, your liabilities, and your owner's equity, which are the three parts to your balance sheet. Okay, there's also a thing called Sarbanes-Oxley, and I think we talked about Enron at some point. I remember this class or another class where they were using hinky accounting principles to make themselves look way more profitable than they were. And because of that, and I think it was 4 or 5 companies, WorldCom, I'm trying to remember, I think it was Tyco International, and then a few more that really were using, Enron was the big one that everybody knows, but they were using these, just what I said, hinky financial practices and accounting practices to make themselves look more profitable. So, I'm understanding it should be that's what I get for trying to type something. The Sarbanes-Oxley Act. So that act came into creation because of Enron and those other companies. So what we'll do is we'll watch a quick video. Let's make sure I am sharing my sound. Awesome. Do me a favor and let me know. Well, it should be a link. There we go.
I'm so fat.
Brendan, you're not fat. It's the shirt. Look at Nate. His true classic is tight around the chest and shoulders and arms.
For those of you who are not involved with the exciting world of accounting, wise move. I like that.
In late 2001, people began to notice some accounting irregularities with a large publicly traded company. The company had a national reputation for consistency in both good times and bad, so it was considered a blue-chip stock. The name of this company was Enron. Within weeks, the stock went from over $90 a share to being nearly worthless. This occurred because the management team tried to cover up losses from the previous years by altering their financial statements. The deception that occurred gave the public a reality check, and in effect, investors started taking a look into the financial records of other large corporations. The Sarbanes-Oxley Act was introduced into Congress by U.S. Senator Paul Sarbanes of Maryland and U.S. Representative Michael Oxley of Ohio. Their intention was to create a law.
Those guys just look like politics, don't they? If you went to the encyclopedia and looked up the word politician, their picture would probably be beside it.
Law, which would restore the faith of investors back into corporate America. By imposing stricter standards on financial reporting, there would be an increase in the reliability of the financial statements created by any given company. Let's take a deeper look at what the Sarbanes-Oxley Act includes. First, officers of the company are required to sign financial statements for accuracy. This holds them personally accountable for any misrepresented data. Second, an increased fine and/or prison sentence was set for individuals who attempt to defraud investors or misrepresent actual figures. Third, the company must provide a description of its internal controls. This is an attempt to increase the confidence of the public in that organization, while allowing them to gain an insight into the company's procedures. Fourth, the company is responsible for hiring an independent accounting firm to come in and audit the accuracy of their financial reports. The financial reports are now required to have a section dedicated to the auditor's opinion as to the accuracy of the figures presented in the reports. Fifth, the company is now mandated to report all off-balance sheet transactions on their reports. Finally, the Securities and Exchange Commission is given more power to look into companies that are suspected of wrongdoing. The SEC will now do random reviews of companies to ensure that they are complying with the Sarbanes-Oxley Act. Their reports are then published and released to the public for viewing. The SEC has a special division that is designated to work with Sarbanes-Oxley issues. This division is called the Public Company Accounting Oversight Board. We hope this video helped to educate you on the world of Sarbanes-Oxley.
So y'all saw the kind of fines and everything else that can go to a company, $1 million to $2 million, and you put the people in charge in jail. So it's the real deal. And it's because of, the hinky accounting. Does anybody know what a publicly traded company really is?
No.
Okay, so a publicly traded company is someone who went out and sold shares of their stock on the Dow Jones or Nasdaq or whatever one they decide they use. So that's part of the deal. So when you hear IPO, initial public offering, what that means is a company has sold shares of their stock in order to raise money. Now, Facebook did it. A lot of companies do it. And as a stockholder, you actually own a small piece of that company. And many of the stocks come with votes, so you can vote on chairman of the board and things of that nature. So and so the more you own, the more votes you get. And you'll see some of these people, these large investors, buy up large amounts of these companies. Now they also have what's called a hostile takeover, which is someone goes out and buys enough stock to control 51% or 50% plus one, but they control 51% of the company. So and they'll do it kind of under the cover. They use shell corporations. They may buy it directly, but they'll use that to take control of the company because, like we said, each stock makes you an owner. Okay, more extra stuff. And I don't remember if it was in this class or another class that we brought this up, but according to public law, The US tax code is 6,871 pages. When you include the federal tax regulations and the official tax guidelines, the number of pages rises to approximately 75,000. This will take an average reader about 14 weeks to finish. So it's huge, it's complicated, and they keep building on it year after year after year after year. I'm gonna ask Mary and I think Robin too, am I coming over okay? Is it you guys having an internet problem or is it me? Am I having an internet problem or is it you, Mary and Robin? Because y'all keep blinking out. She's frozen.
I don't know.
What'd you say, Mary?
Said I don't know. Could be me. My internet out here in the sticks is not great.
Yeah, I understand. Robin said it's hers. Okay. I just wanted to make sure it wasn't me because being upstairs in this office, sometimes I get hinky internet through this Wi-Fi because the router is way on the other side of the house downstairs. So we see, and what we're going to concentrate on is the 6,871 pages of the actual tax code. The tax code will have approximately, at that size, 3,100 words. So that's a lot. And to give you a frame of reference, the King James Bible has 788,280 words. War and Peace is 560 words. And the entire Harry Potter series is over 1 million. So you see, I got the Deathly Hallows over there. So if anybody's been around me more than 5 minutes, no, I can bring Harry into anything. Okay, so who uses the accounting information? All these people: managers, stockholders, employees, creditors, suppliers, government agencies, news media, competitors, unions. When I ran the horizontal drilling business, suppliers wanted copies of our financial statements. They want to make sure we could pay them. You know, same thing with creditors, government agencies, to make sure you're paying the right sort of taxes. Unions are big, but right here we have managers, stockholders, employees. These people here want to know that the place they either work for or they manage or they own stock in is financially viable. Okay, we have public accountants. They provide services such as tax preparation, external auditing, and management consulting to clients on a fee basis. So this is where you have your CPAs come in. Now, to be a CPA, you have to go through college, and then usually as an accounting major. And I don't remember if there's what the continuation is, but I know in the end of it, you have to take this huge test to become a CPA. I even think you have to work under a CPA for a certain amount of time. I don't remember if it's like when I was in engineering school, to be a professional engineer, what they called a PE. Depending on what degree you had, you have to work under a professional engineer for 4 to 6 years before you could even sit for the test. And so I think the accounting is something similar, but who knows? I'm not an accounting guy. My first undergrad was in finance, which they put finance accounting in, like, you know, the same school, but it's not the same. It's nowhere near the same. Okay, management accountants. They work within a company and provide analysis, prepare reports, financial statements, and assist managers. In these companies, it's really important. Now, in smaller companies like what we had, our CPA did a lot of this. They prepared the financial statements, and they prepared the reports and got everything ready for our tax time every quarter. So we would gather up all this information and get it over to them so they could get everything filed correctly and give us a financial statement. And government accountants perform accounting functions for local, state, or federal government agencies. Now, we need to realize that government, the state, federal, local governments, they don't follow the same accounting rules as normal companies do. And so they're allowed a lot of different things that would put the rest of us in jail. So as a government agency, they can get away with a lot more. You know, look at Social Security as a Ponzi scheme. You know, that started out is the people who are working at the time were paying for the benefits they were giving out at that specific time. Okay. So you weren't setting up paying forward, you know, you're not paying taxes and it goes into account for yourself. Now, although they send you a statement, has anybody ever seen one of those statements for Social Security where they send it to you and say, yeah, if you retired now, this is how much you get. If you're a disability, if you passed away, this is what your children or wife would get, the whole works. But
My mom actually got one in the mail last week. I
What?
didn't understand it. She wasn't here, but she had me open it. I didn't understand any of it. She's like, so if I died now, I get this much.
well, or you would. Well, no, because I assume you're a self-sufficient over 18 person. Most of it for children under 18. As I said, there's a disability piece, or my mom, when my dad passed away, she gets a small portion of what his Social Security was, and then she gets her own. Of course, it doesn't actually amount to much what she gets from his, but you know, a little bit helps when you're on a fixed income. So, but like I said, government accounting is a completely different animal. If we did some of the things they did, we would be in jail. Get back off Social Security, because then I'll tell you what I really think about it. Okay, financial accounting is a branch of accounting that prepares financial statements for use by owners, creditors, buyers, and other external stakeholders. And we talked about who those were. Stakeholders need this information to analyze the financial condition of the firm over a period of time. Now, you know, stockholders will use this information to decide if they want to keep the stock, if they want to sell it out on the market, and all that can be done. And if we remember Enron, it went, what they say, it went from $90 a share to nothing. And that happened, you know, almost instantly. And it can happen to almost any company that gets caught, you know, doing something hinky, or, you know, they have some sort of disaster. Did I see that there was another train derailed in Ohio? I don't know how. Go ahead, Tamala.
Oh, I was just going to say, I think so. I watch the news every morning, and I believe this morning they said that there has been another train derailment. So it's like they said the investigation that's going into it, they said somehow they're finding it to be suspicious.
Well, yeah, that's you know, both in Ohio, both within weeks of each other. That does sound suspicious. Because you look at things and, you know, sometimes they're coincidence, sometimes they're not. I don't really believe in coincidences. I believe, you know, there's some external factor usually happening here. I'll give you a coincidence, which in the last year, 5 houses on my block have burned. Mine was the 5th one. Mine was, of course, electrical. The other ones, I think, there's a few of them might have been set. But the weird thing is, it's 5 houses in a row. So, you know, not all over the place, but in a row.
So I have a funny coincidence that has to do with fire too. I
All
grew
right.
up in Collinsville, and the fire department put in a petition to have a new fire station built because theirs was very, very old. And the city said, you can't, it's a historical building. We will never tear it down. And very mysteriously, just a few weeks later, it caught on fire and burned to the ground. Every part of it except for the room where they kept the records.
Coincidence?
Coincidence.
Exactly. Well, you said you grew up in Collinsville.
Yep.
Okay, we won't hold that against you. Now,
I mean, you can. I wouldn't blame you. I know the
well,
people
and
from there.
just as an aside, I did a Freedom of Information Act request for the last 2 years on how many structural fires we had here in Okmulgee, a town of
Yeah.
11,000 people. 95. Once again, coincidence? I say not. But in the, I say amusing thing, amusing, our house burnt, what, a month ago. But about a year ago, did anybody hear about the black apartments that burned down here in Okmulgee? And before somebody says it's racist, the black are the people who owned it, the blacks. So that's why they called them the black apartment. Their last name was black. So they call them the black apartments. Huge deal. Where there was a house next door to it that my wife and I looked at about buying about a year ago, and that house burned down along with the apartments because it was next door. So no matter what we did, even if we bought the house, we'd have been messed up. So back to this. Generally accepted accounting principles, also called GAAP, as a set of accounting standards used in the preparation of financial statements. And what we're mostly talking about here is what happens in the United States. Each country has their own acceptable accounting standards. So if you're a subsidiary of a foreign company and you have a branch here, the branch in America has to abide by those accounting standards, as well as any main company will have to have accounting standards in their company, whether it be China, India, Great Britain. I'm trying to think of some major ones. Back in the day, Japan, back in the 80s, everybody thought Japan was going to take over. And then their economy ended up collapsing as well. Financial Accounting Standards Board, FASB or FASBA. I don't think that's actually what it's called, but establishes the generally accepted accounting principles used in the practice of financial accounting. Aims to ensure that financial statements are relevant, reliable, consistent, comparable. They're all okay. Financial statements, they report the financial position of a firm by identifying and reporting the value of the firm. Okay, and once again, we talked about the balance sheet. You have assets, you have liabilities, and you have owner's equity. Now, your assets have to equal your assets and what's the other word I used? I just lost my brain. You might help me out here. Liabilities. Your assets have to equal to your liabilities and your owner's equity. So that's why they call it a balance sheet. One side of the balance sheet has to equal to the other. If it doesn't, then you have an issue. Okay, assets or resources owned by a firm. Liabilities or claims that outsiders have against the firm's assets. So creditors, debtors, everything else. Here's a little tidbit as well. If you are a stockholder in the company and they go into bankruptcy, have to liquidate whatever they do, you're the last person to get any money. The creditors and have a first dibs at any after they sell their assets of any money they need to reclaim for what the company owes. So usually at the very end, stockholders don't get anything, because otherwise, if had enough money to pay off the creditors and pay the stockholders something after liquidating, then they probably wouldn't be in as much trouble and they wouldn't have to file bankruptcy. And owner's equity claims that a firm's owners have against the company's assets. And many times, part of that is owners put money into the company, especially smaller companies. And they'll do that more than once, because many times companies need cash, sometimes almost immediately, because they haven't been paid yet. I know in the drilling industry, it was standard. They would you would sign a contract and they would say that they would pay you in 30 days, but the real standard was you wouldn't see any money till 90 days. And so at that point, you know, we may have $250,000, $500,000 tied up waiting to get paid. So you have to put your own money into it or go get a loan or do something like that to make payroll and to start the next job. Okay, and it reflects the accounting equation. Assets are equal to liabilities plus owner equity, which I already went over. The income statement. Okay, and we're going to talk about main three here. The income statement reports revenues, expenses, and net income that resulted from a firm's operation over an accounting period. Once again, this is going to be a snapshot of what has happened over a period of time. You know, every quarter, every year, but it's a snapshot. It just gives you this one piece. Revenue increases in assets that result from activities intended to earn money. So revenue is how much you bring in. Now that doesn't mean that's what you made in profit. That's just total of, you know, sales or whatever you're into. Let's just call it a company that does sales, you know, sells a product like, I don't know, give me a product, cars. I'm all about cars. So GM makes gosh knows how much money off selling these cars, but that's just revenue. That doesn't tell them how much money they make on each car over a period of time, because expenses, resources that are used up as a result of business operations. You tell them from Morgan, business, a businessman. And so in a car company, that would be cost of sheet metal, cost of, I don't know, paint, cost of, you know, machining, all these other things. So, you know, it becomes very expensive to create a product. And so the profit margin is going to be your revenue minus expenses for that. And it's a lot more complicated, and we're going to get into it a little bit, but once you subtract all that, because you have different sort of expenses, that's going to be your profit margin. Now, when I worked for that Conoco job, where I was operations manager for 6 years, we ran on a very, very thin profit margin. We just sold high volume. So, you know, so you can do it that way, or you can sell, you know, a lot of people sell low volume and there's a larger profit margin in that. Okay, and it reflects the equation revenue minus expenses equals your net income. Okay, financial statements, a statement of cash flows. It identifies the amount of cash that flowed into and out firm through the following activities. Cash flows from operating activities, cash flows from investing activities, also investment, right? I think Bob always says, you know, there are 3 ways to become rich, or ways to make money: work for somebody, work for yourself, or let your investments pay you. But investments are a tricky thing. Like I said, all the people who had invested in Enron, you know, a lot of them were rich on paper when the thing was $90 a share. But when it went down to nothing, they lost all that money, and many people were no longer wealthy. And that is one of those things that happened, is a lot of these people are rich on paper. Now they're rich anyway, but you know, we talk about like Jeff Bezos or Bill Gates and things like that. A lot of their money are tied up in stocks and things of that nature. So they can't, they don't have immediate access to $160 billion or whatever it was. That's why Elon Musk had to sell stock to buy Twitter, because although, you know, we know he's worth, I don't know how much he's worth now because he lost some money. Tesla stock went down, but you know, it says you're worth billions, but a lot of that is tied up in your company, in stocks, and other investments. So when you hear people say, well, billionaires aren't paying their fair share, well, a lot of that is because their income is not based on, what their net worth is. So, their income may be a lot smaller. They may pay themselves a lot smaller or much smaller salary, and that's what they're going to pay their taxes off of. It's not going to come, they're not going to sell their stock and reap the benefits, at least not at that point. Okay, cash flow from financing activities. That's your statement of cash flows. Now, there are other statements here. Statement of retained earning. It shows how retained earnings have from one accounting period to the next. Stockholders' equity statement shows how net income and dividends affect retained earnings. Now, dividends are, if you own a stock, sometimes the company will pay dividends, which is they will put money back into your account for just owning the stock. It shows changes in stockholders' equity, such as changes that arise from the issuance of additional shares of stock. Now, and that's part of, you can issue a limited amount of stock. Hey, Robin. Oh, she came off mute, so I thought she was going to talk to us. But so you may maintain control of the company and keep 51% of it, and then you may sell the other 49% as a stock. So you can raise money for various reasons, to operate the company, to put money in your pocket. There's all sorts of things, but there's a lot of money that goes in your pocket when you do that. Okay, how to interpret financial statements. Checking independent auditors' reports. And remember, these companies have to have an outside auditing company come look at their books. Checking notes to financial statements. Looking for trends in comparative statements. Okay, they do a horizontal analysis, which compares account values reported on the financial statements over 2 or more years to identify changes and trends. And if you notice Enron, at some point their earnings were always steady. And as their earnings, perceived earnings that they were showing on financial statements, they were pretty much increasing the size of the company at the same rate over years, which should be a clue. Because if a company grows at, let's say, a 3% rate every year, just like clockwork, then something is hinky, because no company is going to grow at the same percentage year after year after year after year. The independent auditors report. They're prepared after conducting an annual external audit of financial statements. So they're going to come in, they're going to do an external audit. They're going to look through all your books and make sure you did things correctly. And by the way, you have to pay for that. So when Sarbanes-Oxley came about and they said you have to have an independent auditors report, they also said you have to pay for that. You don't get it for free. The government doesn't pick it up. None of that. So they're going to add an expense to your company. Thanks, Enron. This is to verify if financial statements are prepared in accordance with the GAAP, fairly present the financial conditions of the firm, and includes in the annual report that a firm sends to its stockholders. So you're going to get a copy of these independent auditors reports, and you'll see if it's a publicly traded company, you should have access to all the reports they have. All right. They no longer get to keep their financial statements to themselves. Okay? Anybody can take a look at those. Now, if you're an independently owned company, you don't have stock you're selling, you have 2 or 3 owners, 1 owner, whatever it is, there's some privacy in those financial statements. I mean, you're going to give them away to your creditors, The other owners are going to get it. The government's going to see a copy, but it's just not put out there for regular Joes. Okay, notes to financial statements. And this is what they said something about notes earlier. They disclose additional information about a firm's operations, accounting practices, and special conditions. They explain the specific accounting methods used to recognize revenue, value inventory, and depreciate fixed assets. Now, inventory was another weird thing. In Oklahoma, at the end of the year, whatever inventory you have to pay 1% of the value of that inventory in tax, which doesn't seem like a lot of money unless, you have a lot of inventory. In the oil company, we would towards the end of the year stop buying as much oil as we could get away with and knock down whatever inventory we had to keep that 1%, as low as possible. Okay, the notes also disclose changes in accounting methods or any risks that a firm may face. Budgeting, very important, right? It's a management tool that shows how it will acquire and allocate the resources needed to achieve its goals over a specific time. Has anybody ever had to do a budget for their job?
No, just
No
my
one?
personal budget.
Oh yeah, don't even talk about personal budgets. Mine is a mess. I don't have assets like we used to. Budgeting facilitates planning by requiring managers to translate goals into measurable quantities. So, we want to grow the companies, by 5% this year, but we're going to need another manufacturing facility or storage warehouse or another piece of equipment. So you budget for that into the future, which is what we had to do, because as we grew our business, we needed more horizontal drills, more trailers, more trucks, things of that nature. Now, you also, companies get an allowance. We don't really call it an allowance every year by the federal government, that you can get a tax write-off for, and I don't remember how much it was. It's probably changed since then, for a certain amount of money if you spend that money on physical assets by the end of the year. So as we would, as we'd operate through the year and the end of the year was coming, if we had any money, or if we had any money left over for that tax write-off, we would buy a new truck or new computers or whatever. Now, you don't recoup all that, but you recoup a percentage because you can write that off in your taxes. Okay, they also identify specific resources need to achieve a goal. New house, new manufacturing facility, new drill, new trucks, new networking, new internet, new intranet, new computers, all this stuff that you may need to grow a company and budget out for, or just to run your company. We don't have to talk about growing, just to run your company on a regular basis, because as you go on, machines wear out, things break down, you have to, repair, you have to replace, you have to upgrade, and so you have to budget for those things as well. Time check, we got 10 minutes. The advantages of budgeting: help managers specify how they intend to achieve goals set during the planning process. Now, a lot of companies, your department will get a budget and it'll be made by someone higher up, and they say, okay, you get this much money this year to run your department. And that is to pay salaries, that is to purchase the things you need. And a lot of stuff comes out of your budget. So you have to be really careful what you do, because if you go over budget, you get in trouble. Now, the problem with that is many times if you go under budget, then next year they'll give you less money because they figured you didn't need it this year. And I've seen that happen as well. Okay, budgeting encourages communication and coordination among managers and employees. It serves as a motivational tool. Okay, if you can do this, this is what your budget's going to be. Help managers evaluate progress and performance. Okay, did you spend all your money? Did you spend more than all your money? Did you spend less? How did you utilize that money? Many times, even budgeted in would be, I've lost the words again. It's always Monday night. I get dumb. Bonuses for people are also budgeted in. My son works for a casino, and they get bonuses, and those bonuses are going to be budgeted in the same way as they do at Walmart when the bonuses they give. Although they used to be a lot larger back in the day at Walmart. Top-down budgeting and bottom-up budgeting. Top-down is top management prepares the budget with little or no input from middle and supervisory managers. That happens a lot. Bottom-up or participatory budgeting, middle and supervisory managers are allowed to participate actively in the creation of the budget. And I've seen that happen as well, but I've also seen that just kind of turn into a brawl almost. Not physically, but people are vying for this money and they're trying to get as much as they can for the department. Budgets, operating budgets that communicates an organization's sales and production goals and the resources needed to achieve them. Everybody is looking to grow their company. If your company is not growing every year, if it's staying stagnant or even going the opposite direction, then that's an issue. And you may be in a dying industry. Buggy manufacturers really took it hard when the cars came about, right? When Henry Ford decided to make his cars, then horses and buggies eventually just went away. Now, there were times where you'd see all of them on the road, and also Henry Ford said, you can have your Model T in any color you want as long as that color is black. Yeah, they only pay them in one color. Financial budgets focus on a firm's financial goals and identify the resources needed to achieve them. And master budgets represents a firm's overall plan of action for a specified time period. All right, so master budget, okay, you have, or developing it, you have sales budget, production budget, selling and administrative expense, but it's expensive to have salesmen out there. We have direct labor, direct materials, and overhead costs, which go into this production budget, because a lot of these overhead costs, a lot of these fixed costs you're going to have, and we'll talk about fixed costs, they never change within a variance. If you're paying a mortgage or you're renting a building, that is a fixed cost, because it's not going to change. And it doesn't matter if you sell 10,000 widgets or 100 million widgets, those costs remain the same. And then you have budget and income statement, and your budget, has budget, capital budget, and budgeted balance sheet. So all those come into play. A static budget is based on a single assumed level of sales. The real world sale, and the problem with that is real world sales vary considerably from the forecasted value. Many times, you're going to know what your sales are going to be and how much you're growing from year to year. Many times, a lot of times, that just gets blown out of the water. Either you're more successful or you're less successful in the sales process. Okay, figures become inaccurate can be avoided by preparing a flexible budget. flexible budget is developed over a range of possible sales levels and appropriate budget levels of cost. So, you know, as sales grow, you get more money. As sales are reduced, then you know your budget is not going to be the same amount. Okay, we have a difference between financial accounting and managerial accounting. Financial to external stakeholders, stockholders, creditors, and government regulators. That's who and information provided is available to the general public, and that's in a publicly traded company. The managerial accounting is intended to provide information to internal stakeholders such as managers or specific divisions or departments. This information is proprietary, which means not everybody gets to see it. In fact, not everybody in the company gets to see that. Only it's, you know, it's like I said, I want to say need to know because that sounds a little off, but yeah, only if you have a purpose for seeing this. The janitor doesn't get to see it. The guy on the assembly line doesn't get to see it, or guy or gal. Okay, focuses you exclusively on financial information. That's under financial accounting, and it reports the standard set financial statements. They have on a managerial accounting both financial and non-financial information, and it prepares customized reports to deal with specific problems or issues. So it's just going to be different. And timing of reports. Financial accounting presents statements on a predetermined schedule, usually quarterly and annually. So every 3 months and then every year. So you get to see a report how they did every quarter and then one over the entire year. That way you can compare it to the quarter before, the year before, and the year before that. And you'll see many times that a company's revenue is cyclical. Okay. Like in the oil business, spring, summer, fall, early fall, those we made all our sales because we specialized in large construction companies and trucking companies. And large construction companies, a lot of them are not doing as much work in the winter. So our sales would drop. So and we'd have to prepare for that financially every year, knowing that during the winter, we weren't going to sell as much as we did spring, summer, and fall, early fall. Adherence to accounting standards. Oh, I mean, adherence to accounting standards. I'm trying to make it sound like a question. Financial accounting is governed by GAAP, and the internal managerial accounting. The procedures are developed internally and not required to follow GAAP because this is information for people who are running the company, and it's like I said, proprietary information. And then time period focus summarizes past performance and its impact on the firm's present condition. Provides reports dealing with the past performance. This summarizes past performance impact on the firm's present condition, which is financial accounting. The managerial accounting provides reports dealing with the past performance, but also involves making projections about the future when dealing with planning issues. So that's all internal stuff. All right, let me stop the share. It is 7:29, ladies. As we know, I'm going to stop recording, which is the official end of class. And then if anybody wants to stick around, has questions, I'll be here. If not, and thank you, ladies, for being here in these 4 weeks. Don't forget, there's a hard deadline Sunday night. So if you're a little bit behind or you need to catch up, now's the time to do it. If you have some discussions that you need to do, now would be the time to do it. Because, you know, discussions are a big part. I know I harp on those all the time, but we really have to get those done because it'll help your grade immensely. So here we go. Stop recording.